Hey everyone and good morning. Just today we got to hear from Sensys Gatso Group when they released a press release regarding their financial targets for 2023 as well as keeping their financial targets for 2025. And with me here today in the digital studio to talk a little bit about this news, I have Ivo Mönnink, CEO. Welcome.
Hello, thank you. Welcome, Michael.
So before we get into the press release that you communicated to the market today, I thought you could begin by telling us a little bit about yourself and the company. Who are Sensys Gatso Group?
Okay, my name is Ivo Mönnink. I've been working in an international environment, commercial roles for 14 years. Thereafter, I was for 15 years a CEO of tech companies. And in October 2017, I became the CEO of Sensys Gatso Group. Sensys Gatso Group is actually Sensys and Gatso. Sensys has been the technology provider to Traffic Fairgate, our largest customer, since 1997. And so we have, through that, we are can also adopt the Vision Zero statement, which is now a very important movement in the world. It was merged with Gatsometer, a Dutch company originated by Maurice Gatsoides, the inventor of automated traffic enforcement back in 1958. And that merger took place in July 2015. We have around 10,000 systems installed. We operate in 70 countries. We have 70 entities around the world, from Australia, Middle East, Europe, and in the United States. We employ 280 employees. Our largest market is Europe, followed by the United States, which is a growing market for us, but also a good business in APAC and in the Middle East. 2022, we had a turnover of around 500 million and an EBITDA of 70 million. And we have an ambition to grow that within the next 2.5 years to 1 billion of Swedish kronor and 600 million of recurring revenue, what we call TRaaS, and an EBITDA of minimum 15%.
Precisely, the 1 billion goal is for 2025, I believe, and you're keeping that goal. But today the market could read about the new financial targets for 2023 in particular. I thought you could tell us more about that first.
Well, I mean, a couple of things came together in the past period. First of all, last week we communicated a reverse split of 80-1. We have had a record high order intake in 2022, and we also see quite a lot of activity going on in the first month of the year already, with orders coming from all parts of the world, I would even argue. So we feel it's a really good moment now to start communicating what the market can expect from us in the shorter term, meaning 2023. So we relieved our revenue target, which is in the range of 550 to 650 million. And our EBITDA target being between 10 and 15%. Where we exactly will land has to do with the timing of the projects, and that is based mostly on what the demands are from our customers. So with all that activity going on, we also can confirm now that our target of the 1 billion in 2025 is also confirmed here, with as well as the EBITDA target of minimal 15%.
You mentioned the high order intake for 2022, and this was driven by, amongst others, of course, this order from Swedish Trafikverket in Q4 of 850 million SEK. Yesterday, you also announced a procurement agreement of 152 million SEK coming from the Middle East. Could you tell us more about these projects and these orders? Is there a timeline you can share in regards to them and how they play out in your income statement moving forward?
Yeah, let maybe start with the Middle East order. That is an order for 152 million over 5 years. The first order delivery will take place in 2023, which is approximately 16 million. And then the remainder will be rolled out in the years thereafter. This is what we typically call a system sales order, where we sell the equipment, in this case, to our partner, and the partner then sells to the end customer. But it does, assure us of a healthy revenue coming from that particular customer in the next 4 to 5 years. Then if you take traffic fair get, I look slightly different at that because it's, well, first of all, the single biggest customer we have in the company. We won also the single biggest procurement tender, I would say, in the whole industry globally was won by us. So the 850 million, and that is evenly, I would say, distributed over the next 12 years. So we start off with selling the systems and installing them and maintaining them. And then thereafter, you will get renewal of new installations, and we also get replacements, and we will get repairs and maintenance. So on average, we look at like 17 million worth of revenue over the next 12 years coming from traffic fair get. So you could argue it's almost like a recurring revenue type of deal we have with traffic fair get. So they look quite similar, but they're also different in that respect.
Is the Trafikverket order and the Middle Eastern order, would that be categorized as TRaaS, Traffic Enforcement as a Service?
So for the Middle East, there is a part which is the system sales, selling the equipment, and there's a smaller part which is repairs and maintenance and calibrations, which is also coming to us to a smaller extent because we sell it through a distributor, a partner. With traffic fair get, we do everything. So we do both the sales of the systems and we do the maintenance as well. So that is more, the way we look at it is more like 50% is system sales and 50% is TRaaS sales. So TRaaS in our case means recurring revenue.
Precisely, and if I remember correctly, reading from the 2022 statement, TRaaS makes up a little more than half of your income. I believe it was 58%. Correct me if I'm wrong. But looking at your markets in TRaaS, United States seems to be the most weighed in there, or the majority at least. What is different in your US business model when we compare it to Europe?
Yeah, the business model in the US is only TRaaS. So in the US, well, maybe there's one or two exceptions, but most of the cities, they run their own programs and they outsource them, meaning that parties like ourselves, we own the equipment, we install it, we maintain it, and we send out citations, speeding tickets. We collect the funds and then we split the proceedings from these tickets actually between the city that gets a part and we get a part. And of course, contract by contract, that is different. So that is the US model. If you look at, call it the European model, which is more system sales like traffic fair get, so they buy the systems, so we do it, and then they give us, or a partner, but hopefully us, they give us an SLA for the maintenance over a longer period of time. So the US TRaaS model, which we call full TRaaS, is typically a contract of 5 to 7 years, and then it's being extended most of the time. So even there, we end up with contracts of 10 to 12 years, or maybe even longer. In the example of Europe, say traffic fair get, it's the same. These are also long contract periods, but we're not doing the fulfillment part of the traffic enforcement. That still sits with the government. We do see, however, something happening in the market. First example would be Australia, where the Australian state of Tasmania moved towards the US model, and we are delivering to them. So we are manning the equipment, we own the equipment, we maintain it. And we do the adjudication, meaning that we do the pre-judgment of the citations, but the real collection of the funds is still done by the government. But I do see a shift towards the US model in Western countries, like in Tasmania, Australia. Looking at completely new territory like Ghana, they leapfrog over the ownership situation. So they outsource it, like in the US, completely. So there is a trend, in my opinion, it's not going to happen overnight, but there is a trend towards more full TRaaS in the world.
I'm curious then, when you mentioned that Tasmania and Australia has moved towards the US business models, do you expect any of your other countries to move towards these models? I'm talking European, perhaps?
It could well be. I mean, I think demographics are playing in our favor, meaning that also budgets of governments are going to be under pressure, And if that's the case, they will look for ways of outsourcing more of their activity. So since this is a proven model in the United States, and it's also working in Australia, I would expect that more and more governments will look at it. Clearly, it's also of course sensitive, so it will not happen over time. But if it happens, that movement is going to be has a big impact. Yes, for sure.
I am curious also about the EBITDA margin that you communicated in this press release. Your target for 2023 is a EBITDA margin between 10 and 15%. Q1 2023, the EBITDA margin was 1%, but if we look at the full year of 2022, the EBITDA margin was 14.8%. So you're more or less already there. Why didn't you aim for higher?
Well, there's an important reason is that we have this high order intake that needs to be executed. So that means that we have had to hire quite a few resources, people, and consultants to help us, deliver on time on these projects. So the cost base is actually going up. We saw that by the end of 2022, and we see it also in the first half of 2023. Once these are delivered, then of course the cost base will come down. So you have a situation where you deliver the Dutch tender, which is an order of 250 million, where you deliver traffic fairgate, which is an order of 850 million. The costs are there initially, but no revenue. So the revenue comes later. So this is actually the main reason why we see the cost base being slightly higher in the first half of this year, and it will actually come down later on. And the other thing is that we are in a launch phase of Flux, which is our new software platform, and we don't want to stop that. So we have a couple of things coming together that elevated our cost base and therefore suppressed our EBITDA. Still, we retain our long-term focus, right? If you want to grow, you have to invest, and that's exactly what we're doing. So maybe another comment to make here, it's important for us, for you, for the investor, not to look at this company from a quarter-to-quarter perspective. Bear in mind that we have 12 years contracts. We have in the US 5 to 7 years contracts that are being extended. Don't look at them on quarter by quarter, but look on this from a much longer perspective. That's why when I present to the market, I typically look at 12 months rolling forecast, because that gives you a way better understanding as an investor where the company is actually moving.
But let's talk then about the consolidation of shares. You're currently performing a reverse stock split, and yes, precisely. The consolidated shares will be traded under the new ticker SGG from June 15th. Why are you doing this reverse stock split?
Well, I mean, it's a couple of reasons. I think the company right now is in a different shape than it used to be. So we have demonstrated quite good financial performance in the past years, and we have an outlook which actually predicts an even better future. And that's also based on the record high order intake and the activity level we had in the beginning of this year. And so it's almost like, okay, we want to move away from the penny stock profile we have, but also maybe moving away from the Sensys type of and therefore Swedish type of image we have. We're very proud of it. Don't get me wrong, we're absolutely very proud of it. It brings us a lot. But in reality, 85% of our revenue is coming from outside of Sweden. And if you then look at our shareholder base, we have 80% of the shares coming from Sweden. So there's a disbalance between our shareholder base and how our revenue buildup looks like. So with a reverse share split, we aim to raise the price level, attract more longer-term institutional international investors. And by changing the ticker name from Sensys to Sensys Gatso Group, SGG, we also hope to make a change towards more of a global profile for the company.
And then apart from the attempted rebrand of your share, I'm also curious operationally, what is the next step for you moving forwards now?
Well, I mean, we will also look at maybe some different coverage of the share, meaning that we will also enter into conversations with international shareholders to create interest for the company. And on the back of what we already presented long term, as a company, we should always look beyond that. So definitely, we're also discussing about what the future will be for the company after 2025. And if that's big, then we might want to have the stock market help us out on certain investments to be made. And as I said before, I would prefer to have a shareholder base which is more international than it currently is. It better fits the profile of the company.
Then I wish you the best of luck to that, Ivo Mönnink, CEO of Sensys Gatso Group.
Thank you very much.